Welcome to the Opt-in Podcast. I am your host, Melissa Franks, and this is where we go from surviving to thriving in business. This week, we are talking about data. Don't leave. Please, please, please don't leave. If you know me in real life, you know I love talking about data. It is one of my favorite things because data doesn't have emotions. Data does not lie to you. Data just freaking tells the truth, whether you want to hear it or not. And there can be a whole bunch of drama in business. This is what I mean. You can create a narrative. You can actually tell yourself that the reason that you aren't making any money is because you don't have any leads. And then as soon as you look at the data, you're like, holy smokes, I have a bunch of leads. I'm just not converting them. Right? You can create a whole bunch of drama in your business when you're not paying attention to the data. And so as I have been talking to business owners over the last, decade, but most specifically 18 months, one of the things that I get asked over and over and over and over again is, Melissa, if I'm not looking at the data and I don't know where to start and I'm overwhelmed, what should I look at? And the good news for you is that I have identified the 5 metrics for you to start with. Now, are these the end all be all? Heck no, my friends. These are just the basics. These are the things that are kind of like minimum standards. You must do this. And the other thing that I want to preface this with, and we'll get into it in a little bit, this does not negate the requirement that you look at your P&L and your bank statement every month. Yeah, that's what I said. It doesn't negate that. You actually need to look at your financials. We're going to touch a little bit on adjacency to financials with some metrics that do require the money component, but what you need to be looking at in your business specifically is a whole lot more than just these 5 metrics and your net income and that your bank balance is positive. Now, I, in December, spoke with a handful of business owners, and as we were talking, the question that I love to ask all the time is, how many of you look at your P&L? Some of the room raised their hand. Then when I asked how many of you understand your P&L, like 2 people kept their hands up, and one of them was a wealth manager and the other was a CPA. So you can imagine how that conversation went. I also asked them how many of them look at their bank balance on a regular basis, and that was a mixed bag also. And it's because we're scared, because we know the data tells the truth, because we know that empirically that information is something that we can't argue with. It just is. And we would so much rather sit in the mess of our drama and our opinions and our thoughts than actually look at the real truth. And so today we're talking specifically about how to get to the truth of what's happening in your business and what to freaking do about it if it's not what you want it to be. Fair? So hopefully you're still here and you didn't run away after my 3-minute rant about why data is important. But I'm going to walk you through these 5 metrics also in the show notes, because I will forget to tell you this. You can click the link and you can get these on a piece of paper. So you literally can get what it is, what the formula is, and what to look for, why it's important on one sheet. These are the 5 things to start with for any business. You do not need to be making $1 million to be looking at these. In fact, you should be looking at these well before you make $1 million, because you'll make a whole lot of smart decisions in advance of that and get to the million faster. So without further ado, we are just going to dive right into the very, very first one on the top of the list. And these are in no particular order. They're all really important. Don't think that if you can only track 2, that the first 2 I say are the 2 that you should track. Just track all 5, would you please, on a regular occurrence, like monthly. Anyway, the first one is net profit margin. Net profit margin. Have your eyes glazed over? Have you said that sounds like something that my finance person calculates? I don't know what that means. It's okay. It's okay. All the metric is telling you, all it is telling you is how much of every dollar of revenue that comes into your business is actually net profit. So what it will tell you is if you get $1, somebody pays you $1 for something, it will tell you if 50 cents is net profit, if 75 cents is net profit. You see where I'm going? If it tells you that 5 cents is net profit, that means 5% of all of the revenue that you have coming into the business is net profit for you. If it tells you 75 cents is net profit, that means 75% of all of the revenue that comes into your business is profit. to you because you own the business. See why this is important? The reason this is important is because you will start to learn really what the ratio of your expenses is to your income. This is one way to look at it. It will tell you, are you priced right? It will tell you if you have an expense problem. It will tell you what happens in your business dollar for dollar. Now, a lot of you also know that it's true that your expenses are fixed in your business. So it's the cost of doing business is $100,000 a year. And you could sell $1 million of whatever you sell, or you can sell 5 of whatever you sell. And regardless, the cost of doing business is $100,000. So what that means is that when you look at other metrics, the ratio of your expenses to your revenue will change, right? If your fixed expenses really stay at $100,000, no matter how big you scale, then you will start to see that relationship change. But this net profit margin specifically is talking to you about how much money you put in your pocket after expenses, after taxes, after all is said and done, you paid for all the people and done all the things, how much is actually going into your pocket. The other thing with net profit margin is it takes into account the salary that you pay for yourself as expense. So this is literally what's left in the bank that the business owns as net profit. That's what this is. And that's important because you want to know what levers you can pull to make that bigger. Ideally, if you are making 10 cents on every dollar that comes into your business and you want to improve that and you want to get it to 20 cents, then you know exactly where you need to go and what you need to look at. This has nothing to do with bringing in more dollars, because as long as you're making 10 cents on every dollar, you can bring in as many dollars as you want. You're still going to be making 10 cents on every dollar. Until you figure out how to make 20 cents on a dollar, you're not going to solve the problem. See where I'm going? So that's why I said one of the levers you can pull is price. So maybe your price too low. If you want your net profit margin to increase, then you need to increase your prices. Another obvious one is that your expenses are too high. So go look at your expenses. And that gets tricky. I'm just going to say it gets really tricky. Everybody thinks that they're being good stewards of their money and nobody is. That's what I said. Nobody is. Everybody has subscriptions that they're paying for that they didn't realize they had. I was just working with a business the other day and we had made some changes with third-party providers and we're like, what do we use this tool for? Nobody knew. Nobody knew. Nobody even had the login information to be able to get into the tool to stop paying for it. But it was $35 a month, and you do the math. That was almost $400 a year that the business was paying for something that nobody knew that the business had and nobody could log into to stop the payments. This happens to all of you. And whether it's $400 or $4,000, depending on the size of the enterprise, you can actually spend a whole lot more money without realizing it because you have so much more wiggle room in your books. So when we talk about net profit margin, just remember that this is the one where we talk about how many cents on the dollar or actual revenue for your business. The next one is gross profit margin. And this one is in the sheet and you can look at it. I prefer to look at something a little more sophisticated and nuanced because I think that it actually tells me something more direct. I like to look at something called the operating expense ratio. And this is expenses that are classified as operating expense. It's different than total expense in your business. Your bookkeeper or your controller or your CFO will know the difference. And the operating expense ratio, you want to keep that around 30 to 40%, give or take. So 30 to 40% of all of the income that comes into your business goes to operating expenses. This does not go to capital investments. This does not go to assets that you purchase and manage. This is really a operating expense situation. And the reason we like to look at this is because it's super controllable. It's to a certain extent where there's discretionary spend happening and you can cut the fat. So when you hear these big corporations out there talking about layoffs and you hear them talking about needing to return to a better position of shareholder value, it's one that they love to use all of the time. Really what they're talking about is that their operating expenses have gotten out of control. One of the big businesses that I worked in when we were going through the sale process of one of the businesses, one of the goals that we had prior to sale was even to like get bidders in or to go on the market with the business was to improve our operating expense ratio. And that was because it was at like 70%. And based on the size of the business, it was just an asinine amount of money that we were spending on operating expense. And because we needed to be able to improve that quickly, you know what the solution was? It was to lay a whole bunch of people off. A whole hundreds and hundreds of people. So when you see some of these big businesses like Meta or X, or Amazon, right, do these massive layoffs, it's because they've got an operating expense problem. And the only way that they can improve their net profit margin, which is what we just talked about, which is tied directly to shareholder value and the dividends that shareholders receive, is by improving their operating expense ratio. So I like to look at this for small businesses because if you can have a healthy operating expense ratio when you're small, you can have one when you're big if you manage it correctly. The biggest thing that happens when a business goes from 6 figures to 7 figures or 6 figures to 8 figures is that you just start to spend money like crazy because you know that you can generate more money in the business. And so you're not so worried and not so budget conscious as you once were when you were a 6-figure business. It's just the natural swing of things. Part of it is you have more decision makers. So you have more people controlling the purse strings. It's not just you, the business owner, that's making decisions anymore. You have had to delegate fiduciary responsibility to other people, and they're the ones having to make the decision. But if you can get a healthy operating expense ratio for your business, and all of these are going to be a bit unique and different. I threw out some ratios of 30 to 40%. There's something you want to work with your controller or CFO. Even if you just hire a CFO for a couple of hours to help you really strategically figure out what your financial metrics should look like in your business, I recommend that you do. And once you land on that operating expense ratio, then it's something that you just track and manage. And so if you see it getting out of hand, you know, okay, something has happened here, something material. What decision did I make? What did I do? How can I adjust it? How can I get it back to health? Because if you get it in line, when you grow, if you keep it in line, all you're going to be doing is increasing your net profit. Seriously, that's all you're going to be doing. This one is a little bit complicated. It takes some experts to come in and help you figure it out. But once you have the experts to help you figure it out, you can manage it yourself. You can manage it with your team. And it's a great way for you to be talking about financials to your team. See, this is the cool thing about these metrics is none of these are actually saying how much money the business made. These metrics are just talking to you about how you can talk about the financial health of the business without tipping your hand. So I know I'm going to go off on a side bend for a second. I'll get back to the third metric in a minute. But many of you that own businesses, your biggest objection to tracking any of these metrics is, I don't want my employees to know how much profit is in the business. That's okay. You don't have to tell them. Who said you have to tell them? Nobody's saying you have to tell them. But what they should know are some of these metrics, and they should know what the targets are. So, hey, our net profit margin goal is 70 cents on the dollar. And right now we're at 20. So we need to figure out ways to reduce expenses and generate more income, right? Increase prices, do those sorts of things. The gross profit margin is the same thing. These metrics are a way for you to talk about financials in your business without telling your employees the thing that you're scared to tell them. Now, I'm a little bit unconventional. Shocking. I know. I actually think that you should tell them how much profit's in the business. If you have employees that are coming to you demanding pay increases because the business is profitable for 1 year, you have the wrong employees. Period. Full stop. I have this philosophy specifically that when you do it once, it's meaningless, meaning that you need to be able to demonstrate that you can do it again and again and again. So let's say that you had $1 million a year. Well, go do it again. After year 2 or year 3, you can declare your business $1 million business, but year 1 is just a fluke. Year 2 is where you prove it, and year 3 is where you maintain it. So I'm okay with you talking to your employees and telling them very directly what your profit is in the business, because until you get to a place where you know that you can do it again, it's just a number. And nobody's going to begrudge you for keeping cash in the bank when you don't know that you can do it again. Now, let's say you get 2 or 3 years down the line and you sure as heck are $1 million business or a $5 million business or a $7 million business. It doesn't really matter. Go ahead and tell them the net profit. But by then, they're going to see how you manage a business with cash. They're going to see that you are generous and you provide bonuses and healthy pay increases and like all the things. And so they're not going to come running for your profit. They're going to get inspired by it because they know that you pay it forward. I wouldn't worry so much about telling them the number, in my opinion. People are people and you can do what you want, That's why these metrics are important. But if you live by the philosophy of until you've done it 3 years in a row, it isn't really real, which is my recommendation, then it's just a number. It's just a number. Okay, back on track. The third metric is a customer acquisition cost, CAC. This is something that is getting so much press right now. Everybody's talking about this, probably because everybody's doing digital marketing. So once upon a time, advertising budgets were for big brands, but Main Street businesses didn't advertise. And if they did, it was like super small. It was in the newspaper or direct mail. Like the budget was teeny tiny, so it didn't really make any sense. In today's world, you can spend tens of thousands of dollars relatively quickly on digital marketing. And so the cost of customer acquisition is incredibly important for you to understand. And really all that it is it's talking to you about your sales and marketing efficiency. So how much does it cost you to get a single customer? That's it. And so if you spend $10,000 and you get 10,000 customers, then it costs you $1, right? So the way that this is actually calculated, and you'll see in the sheet, is that you can do it one of two ways. You can scratch that. The way that this should be calculated, and it's calculated a bunch of different ways, is the way that I just said it. Amount of revenue for a specific thing, okay? The amount of spend for the specific thing and how many customers you had. And what you're doing is you're taking a look at how much you spent per customer and how much revenue you earned for each sale, right? So if you're selling something that's $100 and your cost of customer acquisition was $1, it's 100 to 1, right? For every $1 you spent, you got $100 back. That's super healthy, by the way. CAC is significantly lower than that. And the reason that you want to look at CAC is because what you want to know is, are my marketing efforts working? Are my sales efforts working? You can look and see that I'm getting sales. You can look and see people are buying stuff. They're buying stuff over and over again. My revenue's going up. My business is growing, et cetera, et cetera, et cetera. But unless you look at CAC, you don't know if your marketing is effective. In fact, you could just be dumping money into a marketing machine and not actually getting any return. It can still be generating revenue. It can still feel good to you. And if you're not looking at CAC and your operating expense ratio and your net profit margin, you don't realize that you're hemorrhaging money paying for advertising that's not working. See that? See how they play together? So cost of customer acquisition is super, super important because it talks about the one widget that you are selling. How much did you spend to get them to buy it? This, depending on your model, this can include payroll and advertising, social media manager. The danger with this metric is that you don't include all of the costs associated with the acquisition of the customer. If you just think about it for a minute, how are you going from the idea in your head to the person actually buying? What are you using to get them there? Do you have an email tool? Do you have a CRM? Do you have a social media manager? Do you have an ad agency? Are you spending money on ads? Do you have somebody responsible for sales? I could go on and on and on. Are you sending text messages where you have a hosting platform, right? I think I just listed off 7 things that all cost money, some of them payroll, some of them tools, that go into the expense of acquiring the customer. So you need to look at all of that expense and then the revenue that you get from that sale and say, does it make sense? If you're spending $100 to acquire the customer and they're bringing in $50, guess what? Something's broken. You're losing money. Every customer you bring in, you're losing $50. Now, you may be looking at top line and your revenue looks fine and you still have a net profit, so you don't actually realize that your marketing efforts suck. That's why CAC is important. The next one, customer lifetime value. I love this one. So with CAC, I just gave you an example. If you spend $100 and they give you $50 in revenue, you're losing money. But what happens if you spent $100 to get that person one time and their first sale was $50? But over the course of the next 5 years, that $50 becomes $50,000. You spent $100 to get them and you ended up getting $50,000 in return. Worth it? Heck Yes. So what you want to do, and this is why this one is so important, is you want to use lifetime value to evaluate your business model. Do you have something that they can buy over and over and over and over and over and over and over again to increase their lifetime value with you? Or are you a one and done sort of business? If you are a burn and churn, a once and done business, you know what that means? You are going to constantly be chasing people. You're constantly going to be in the lead gen and the attention game, and it's going to be exhausting. Can you grow businesses that way? Yes. Is it exhausting? Yes. This is why businesses like skincare businesses and makeup businesses, this is why network marketing is always focused on consumables. This is why there are so many software as a services businesses. This is why all of these models have popped up, because everybody knows that the stickiness of the customer is what wins. Now, there are a lot of components that go into having a lifetime value of $50,000 for somebody who came in off of a $50 purchase. There's a whole bunch that you have to do to build a relationship and trust and brand. There's a whole other podcast series, to be honest, about how you go from 50 to 50K for lifetime value. However, what this is telling you specifically is my business model working or not? And am I okay with it? If you are a churn and burn business where they buy from you once and they never buy again, as long as you can acknowledge it and say, that's a business I'm in and I love it, good for you. But I want to say something to you. Even car dealerships have lifetime value. How many families do you know that will only ever buy a Toyota or a Honda or an Audi or a Ford, or I could go on and on, right? They all do. The parents do, the kids do when they can have cars, their spouses do. Before you know it, like every time you go to somebody's house, you're like, oh, yep, here's the house where all the Toyotas are. That's lifetime value. That's the dealership spending a whole bunch of money and probably not getting a return on that first car they sell that family. But when they're 15 cars deep, they're just raking in the cash. Even dealerships have a concept of lifetime value, and their products are something that you own for like 10 or 15 years before you buy another one. There is a way in every business model to have recurring revenue and have an increase of lifetime value. You just have to figure out what it is. Now, like I said, if you want to just churn and burn, that's on you. I'm not going to tell you not to do that. It's just high risk and exhausting. Okay, and then the last metric, the very last one, and this one's going to get people's backs up, is employee productivity. You got to know how productive your employees are. You just do. You just do, because they're the biggest expense to the business. You need to know how efficient your team is. You need to know how efficient your operations are. You need to know where there is a hemorrhage of money so that you can go solve the problem. This is operations professionals like me. We love coming into your business and figuring out where you're inefficient. It's our favorite pastime. And you know where we always start? With what are your people doing? In fact, today I spoke with a new client. We just started today. Today's the very, very first day. And the very first thing that we're going to do is I'm going to find out what everybody's doing. And then I'm going to look at how much time they say they're spending on it. And we're going to determine if it makes sense. My guess is that in some cases it will, in some cases it won't. And that's why employee productivity is so incredibly important. You can actually build metrics around this. You can put it in people's goals. You can track it. You can measure it. And the more efficient and effective your team is, the more capacity you have to do really cool things in your business. You have to know if your employees are productive. And this has to be a data over drama situation. You cannot have the drama of, I feel like I'm working hard, I'm burning the midnight oil, sending you emails at 2 a.m, look at how hard I'm working, I'm so efficient. But I'm going to tell you right now that if people are consistently working at 2 o'clock in the morning, they are not efficient. Full stop. They're just not. If your people are context switching all of the time, if you have Jack and Jills of all trades and all of the roles inside of your business, and you're not under $1 million anymore, your business isn't efficient. You need to know what their productivity is. It helps you just manage them better. It helps you ensure you have the right people doing the right things at the right time. It helps you make sure that as your team grows, that you have the right people elevated to the right roles and managing the right people. It just improves employee morale. When you actually know what's happening with your employees and you know what their productivity is, it can also help you find underperformers. And did you know that underperformers actually decrease morale? They actually suck the energy out of a business, because the high performers are frustrated that you're not taking action to address the low performance. Yeah, that's 100% the truth. So employee productivity is another thing that you need to track. And now before I go today, because I wanted to keep this short and sweet because I know it's about data and nobody likes data, but it's important. And that's why we're talking about it right now, is I want to talk very briefly about your profit and loss statement, because it's come up with everybody in like the last week. I don't even know. I've had this conversation a million times. And here's what I'm going to say. There is a basic framework for a profit and loss report, and it has basic structure and tells you basic information. In a nutshell, profit and loss is going to tell you all of your revenue. It's going to tell you what your revenue is, and it's going to tell you what your expenses were, and it's going to tell you if you win or lose, your plus or minus, right? That's all it's going to tell you. Your profit and loss report, however, if used correctly, can be a powerful tool in your arsenal that anybody can understand. And here's what I mean. If you are able to generate a profit and loss report in your business, it's because somebody is coding your expenses in a tool. QuickBooks, Collective, there's like a million tools out there. But somebody is coding your expenses in a tool, and they're classifying them, and they're saying, this is rent, or this is payroll, or this is marketing, or whatever. Okay? And those classifications are important, but that's usually where they stop. Now, what you can do relatively easily is have whoever is doing that work classify your income by each product, by each category of product, by each department or function. You get to, this is where the P&L is magic. You get to decide how things are grouped and categorized. And so some of these metrics that I just talked about, when you go to your P&L to get the source data, what's so cool if you sold 3 products and you were able to know by product what your net profit margin was and what your operating expense was and your cost of customer acquisition. Wouldn't that be so cool? Because then not only would you be able to see product A, product B, and product C, and the split of top line revenue, let's say product A is 50% and the other 2 are 25, you could actually see profitability. And so it could be that product A and product C are highly profitable and product B is not. And so then maybe you say, well, if it's only 25% of the revenue, do we just make it go away altogether? Or can we fix the things that are making it not profitable? But when you see everything in a lump, and just a big old lump, which is how most of you are looking at your P&L, you actually have no idea what's happening. And what I want to say to you with all of the love in my heart is that a bookkeeper knows nothing about your business. So if you want to be able to see data by product or by category or by department or offer or whatever language you use, you have to have the bookkeeper do it. And what that means is that you actually need to explain your business, and you need to explain to them how they can tell the difference between product A and B and C so they can categorize things correctly. And then you need to provide them direction on how to split the expenses across the products. There's some work that you have to do, but when you do it once, then your P&L is set up so that you can actually see the data that you need to make the informed business decisions that you want to make. If we continue with the same example of A, B, and C, they're all different products. They basically are going to become categories over time. What you may want to know is which one is most profitable. Well, we just said that A was most profitable. So that means, hey, can we introduce more stuff in A? What else can we do like A because it's so profitable? What you're not going to do is want to introduce more things like B because B was losing money. Have the data, what you could end up doing is introducing more things like B and killing your business. I want all of you in 2025 to make a commitment that your P&L is going to be a tool in your arsenal that is specific and unique to your business and tells you exactly what's going on. I know that that's asking a lot. I know that you probably just shut off the podcast and now I'm only talking to myself at this point, but this is so important. I learned about financial coding by being inside of a big corporation and needing to do basically forensic accounting to figure out how to stop hemorrhaging money in a business. I sat side by side with a controller and we went through the nits and the gnats and the weeds. I said, can we look at this differently? Can we code this over here? How is that? That's in the wrong spot. It's the only way that you really understand what's happening in the business. I am not recommending that you do that to yourself, but what I do recommend, coming from my corporate world, is that you work with your bookkeeper so that your P&L represents how your business is structured. And when your P&L represents how your business is structured, then you can look at all of these metrics across all of the various verticals in your business, and you can determine what is healthy and what is not, and what you need to take action on. When you combine the power of the P&L with these metrics, you are going to be unstoppable. You're going to see your business in a new and different way. You're going to be able to make decisions in a much more informed way. You're going to ditch the drama and the emotion and the conjecture, and you're just going to be able to steer your business based on fact. All of you want a viable business. All of you want a 7-figure, 8-figure, 9-figure business. All of you want all of this hard work that you have put in to pay off. And in order to do that, in order to get you there, in order to realize that next big goal that you have to leverage data. You have to look at it. You have to understand what it's telling you, and you have to make informed decisions based upon the facts. So I'm going to get off my soapbox today about data and metrics and reporting and the P&L and all of the things. And I am going to invite you to download the document in the show notes so that you can have a little bit more information about the 5 metrics. You have something to carry in your hand to go to your team, say, hey, can somebody help me figure out how to do this if you can't figure it out yourself, and start tracking it. Look at them on a monthly basis. I'm not asking you to look at them every day. Get familiar with your business. Get familiar with the data. I promise you it's going to be worth it. I appreciate all of you so much, and please know that you are wise and you are strong and you are capable, and I believe in you.